Welcome to Echo Trade. This is Jeff Roth, and I'm here with Darren Blonsky from Sonoma Wealth Advisors. They're coming to us from Sonoma, wine country. So Sonoma Wealth Advisors has, I think, 2 years running been nominated by as a top RA to watch in the country. Darren's got, a couple decades of investment management experience, certified financial planner, among many other certifications. So Darren, appreciate you being here. Excited to talk about the portfolio.
Yeah, thanks, Jeff, for having me. It's always fun to talk about what we love doing, and that's thinking about portfolios.
Yeah.
Yes.
Good. So I don't have to think about it. I'll turn it over to you. So the Gazelle Portfolio is what we're talking about today. So why don't you just kind of give me like a quick, overview, kind of high level view of the portfolio and the goals and how the strategy is set up?
Yeah. So great question. So we are a SmartVestor Pro with the Dave Ramsey program. Dave Ramsey is one of those people, you either love him or you hate him. And there's lots of controversy out there about some of his tactics. And in full disclosure, I don't agree with every single one of them. Yeah. I'll tell you where I agree and where I disagree, and that's how we roll. But we do find that Dave does a lot of really great work in helping people structure their finances, get out of debt, build wealth for themselves. There's kind of a stigma out there that Dave Ramsey's for the poor and for the people in debt. And he helps a lot of people who are poor and in debt, but he also helps a lot of people become millionaires using his approach.
Yeah.
I've personally known and still know and work with a lot of people who he's changed their life. So all that aside, love him, hate him, have different opinions, whatever. We're SmartVestor Pro. So we help a lot of people who listen to the show on a regular basis. As a part of our clientele base, we have a couple of different segments in our clientele. And so one of the things we did is we built the Gazelle Portfolio. So one of the things Dave talks about is being Gazelle intense when you're trying to run the baby steps. And one of those might be getting out of debt or saving 15% of your income for retirement. And the idea is to really be focused. So many of us suffer in life because we're so unfocused, and we just have so many different things we're looking at rather than really focus on what matters. And so we built this portfolio to kind of play on that idea, the Gazelle Portfolio. Now, Dave is really particular. He's got some biblical beliefs about not owning debt instruments, bonds, that being the case. Mm-hmm. And he's very careful about that. So it's all equity portfolio. It's all stock. In full disclosure, one of the things I've kind of deduced over time is that Dave has a very large real estate portfolio. And I believe that that's probably more of his ballast to his portfolio, whereas his stock in his portfolios might go up and down all day long, and he's not as worried about it because he has that real estate ballast.
Yeah.
So traditional investors looking to retire are saying, "Oh, I'm going to retire and throw all my money in just the stock market." Not advisable. This isn't advice for you because I don't know who you are. You're listening to this, but in general, it's not a good idea for people to say, "Hey, here's all my retirement money. I'm going to put it in the stock market." Now, there's an upside to that, right? There's always a risk and return trade-off when it comes to investing. And if you're going to take more risk, you can get more return, but guess what? You could also lose a heck of a lot more. And the way we think about risk is we think about risk as the potential for loss.
Yeah.
And so the Gazelle Portfolio is a high-risk portfolio. It's all equity. It's bucketed into 4 different buckets that Dave talks about, which is aggressive, growth and income, international, and then growth and income. So I got aggressive, growth and income, international piece to the portfolio in those 25% buckets with growth in that 4th bucket.
Yeah. So this is it's fitting in the growth bucket.
Yeah, I would even say it's growth with some international flavor to it. So many portfolios we look at from the average investor have no international exposure to it.
Yeah.
And that kind of hurts portfolios. It's actually helped the last 10 years, but long-term, statistically and based upon research, that's not a good way to go. It's also got a tilt in it towards kind of the what people would more think of as the value investor, right? Because it's got those aggressive components, that small and mid cap in it. And those components of it are tilted towards the value side, which tend to outperform growth over time. The last few years, and especially the last couple months, because we're recording this in July of 2023, and the 7 biggest stocks have basically run this market all year.
Yeah. Exactly. So, I mean, you talk about, let's talk about a little bit about, you mentioned it's a high risk portfolio. So where does that risk come from? Does it come from the fact that it's all equity based, or because in relation or relative to, a more fixed income focused portfolio, or is it, the concentrated nature of the portfolio? Where does that risk come from? And then what do you guys actually do to mitigate that risk, even though, like you said, you consider it a high risk portfolio in relation to others?
Yeah. So, a couple things. Risk is a funny conversation, right? So, what's greater is the risk of inflation more important, or is the risk, and that is that actually the value of your money is diminishing, so that if you're not invested, you're actually losing money.
Yeah.
Is that a greater risk, or is the risk of volatility greater? So what we try to do is what I always tell clients. I like to communicate in dollars and cents. So it's like, all right, if I've got a client, they've got $1 million, and that portfolio goes down by 10%, that's $100,000 down in that portfolio.
Yeah.
And when that goes down, what do? Do you stay in it, or do you get rid of it? And if you're going to get rid of it, you're too risky. If you're going to stay in it, then it probably aligns more with your comfort for risk tolerance. Well, an all stock portfolio, you take periods of time in history when the markets were down significantly, like 2008 and 2001 and 2020. Did you stay in it, or did you get out of it? And that's really important to know. We want to keep that number right where you're comfortable with. We find that most clients, even though they might tell us they're really comfortable with risk, at about -10, they're going to want to get out, and we're going to have a conversation. They're freaking out at about -10. That's the magic number, where they're like, what are we doing and how are we protecting it? We're like, remember, we talked about this. You stay for the ride, go in. Well, this portfolio, you should expect a ride on the upside and on the downside.
Yeah. So you're looking to, I mean, at the end of the day, you're going to capture, the market's going down, you're going to be participating at least a little bit in that. And if the market's going up, are there goals with that to, like, hey, we're trying to only, minimize, downside exposure to 85% or 65% or something like that, and then try to outperform in the bull markets?
This portfolio is going to be a little bit more passive than perhaps some of the other strategies. So we're not really interested. So one of the things you're alluding to is upside downside captures, what we call it, right? So in theory, if I could design the magical portfolio, I capture 100% of the upside and 0 the downside, right?
Yeah.
Fortunately, that's not reality, right? And there are portfolios that are more active that try to mitigate some of that downside. We will take a strategic shift here and there if we see something really present. But for the most part, we're trying to stay true to those allocations of 25% aggressive, 25% growth, 25% growth in income, and then 25% international.
Yeah.
And now it's funny because I've always asked, like, where do those terms even come from? Because there's a big brokerage firm that uses them out there, and then there's a mutual fund company that uses them out there, and then like nobody else uses them in the industry except for Dave Ramsey and those two companies. And so, the way to think about it is aggressive is going to be small and mid cap companies. So these more companies that tend to go under, that either really become successful or don't do well. You tend to get the black or white with them more, not a lot of putting along.
Yeah.
And then you've got the growth stocks, which tend to be those tech high flyers. Those are those companies that don't pay a dividend. They're going to take the money they earn as a company, and they're going to buy more buildings. They're going to buy other companies. They're going to acquire. They're going to grow, growth, i.e. growth. And the growth and income strategies say, okay, we made some money. Let's pay it out to some of our shareholders. And then you have the international, which are going to have developed markets and emerging markets in it. And then that's where we get a little more creative around it. The international world there's a lot more to make decisions about in the international world, in our opinion, when it comes to asset allocation. And that's where you're looking at what's our exposure to China, right? Because you look at the emerging market index, it's a very significant portion of emerging market indexes are focused on China.
Yeah.
And then you have the developed markets, and then you got the whole mess that's going on over there with Russia and Ukraine. You have to factor into the situation, and most recently France. So there we'll use a little bit more of kind of strategic thought and be a little more active in the portfolio. But for the most part, we're going to stay true to those buckets and let it ride.
Yeah, I mean, so that's interesting. I mean, compared to like a lot of different portfolios that you have your large cap U.S. portfolio where it's very focused on those large cap companies, in the U.S. obviously, versus what you guys are doing is you're really kind of broadening the spectrum across market caps, different company sizes to have some of those smaller companies that can really kind of outperform, as well as some larger companies, as well as going international and U.S. So it's really kind of across the spectrum, like you said, those four buckets. So it's a really comparatively diversified portfolio in terms of the different areas that you guys are looking to actually invest in.
Yeah, it's funny. We have kind of a different theory on investment management. We kind of look at investment management. It's like when you go to a hotel, Jeff, and if you're in that hotel and you show up and those sheets in your room are dirty, you've got a problem immediately. Yeah. You're moving, you're going to the front desk. And sorry to use the crude example, but it makes a lot of sense. And we look at that to be true with investments too. We find that most people, 99% of people, really mess their portfolios up because they're too active. Yeah. They think they're smarter than the market. Truth is, they're not. Yeah. And you think of like some of the deities of Wall Street, they only really beat the market for very short periods of time. And so anyone that comes to me and says, hey, I got this really fancy strategy that's going to make you tons of money and it's going to print, I'm asking a lot of questions, and I'm wondering how honest this individual is with themselves. Now, that's not to say, like with Echo Trade, where you can take advantage of some of the thinking, that there are ways to trim around the edges, right? Yeah. And the way to think about that is, you show up at that hotel and you got clean sheets. But I remember this one cruise we went on years ago as a family. It was a Disney cruise, right? And we went on this Disney cruise, and every night we go back to our room and there'd be this towel that was folded like different animals. And it was that different touch that the kids just loved. And I think of it very similar when it comes to investment management. You're going to have a core portfolio. It's going to stay the course, just going to be allocated reasonably. And then you might trim around the edges with some satellite holdings. That's how philosophically we look at it. We think most people make mistakes because they try to make big strategic decisions about the core of their portfolio rather than trimming the edges. You want to own NVIDIA? Great, own NVIDIA, but don't do it with the core of your portfolio. Yeah, exactly. So in terms of what your process is, I mean, like the screening process to decide what you're investing in, what's going into the portfolio. I mean, so and correct me if I'm wrong, this is primarily an ETF-based portfolio. So you're investing in ETFs, not individual stocks, correct? That's right. And so let me say a piece about that, Jeff, because Dave Ramsey's really keen on mutual funds only. And I pushed back to the Ramsey people in recent. And I said, hey, ETFs, like mutual funds are a lot more expensive, not ideal for a lot of reasons. So we went ahead and plowed forward and kind of were sacrilegious and did the ETF thing. And I did notice, though, because I was just checking on his website before I came up here, they have removed the do not invest in ETFs label. So we are now in compliance with in the Dave Ramsey world. For people that are really into it, there's Davish. We're not Davish anymore. So, you're at the forefront of pushing Dave into the right direction on not pigeonholing themselves into mutual funds only. I won't try to suggest that I have any influence over Dave Ramsey, nor do I want to. We like to keep an arm's length. We think he teaches a lot of good things, but we also think he teaches some things that are not so correct. But we do think he helps a lot of great people, and we're able to help a lot of great people through his work too. Yeah, perfect. So talk about then the investment process and what goes into choosing what ETFs you want to throw into the portfolio then. Yeah, so there's a dime a dozen ETFs out there. The first thing we're going to look at is we're going to look at the managers and what's going on and what's the underlying kind of track record that they have. Then we're going to look at size. We're obviously going to stick to the bigger ETFs. We're not going to get in a lot of boutique-y. There's a lot of, so ETFs were kind of like index passive for many years, and then they've kind of like transitioned to more active. And I've noticed as of late, like, so we're in wine country, right? And so in wine country, every tech giant, millionaire, billionaire has their pet winery in the Sonoma, Napa, Healdsburg Valleys areas, right? Yep. And I kind of look like it with ETFs, like any like Twitter, kind of personality on CNBC has now their pet ETF out there. So we try to steer away from the pet ETFs. We don't like that. We like the big broad ones. Remember, we're going for passive allocation, for big sector exposure, international, but we'll look at things like, we like a particular ETF. I'm not going to give the name on the show, but there's one ETF we use in a lot of other client portfolios as well, where it's emerging markets ex-state owned. And meaning that it filters out any of the Chinese-owned companies. Now, one could argue every company in China is practically Chinese-owned.
Yeah.
But the idea is to kind of steer away from the government-owned companies that have that kind of geopolitical risk in there. Our job is to preserve your core, to keep your core growing, to make good choices around how you manage that money, and then trying to help you stay the course and not get out when things get dicey.
Yeah, I mean, that's perfect. That's what everybody needs. Like you said, you need to have that core, and then there are portfolios on Echo Trade to have that on the edges to be able to try to outperform in certain market conditions, but having that core and be able to lean on expertise like you guys, it's awesome. I love partnering with you guys. From when we first started talking, years ago, I think pretty much always been a good partner. And so thanks for kind of adding some insight into the Gazelle portfolio, and investors can check it out on Echo Trade. So thanks, Darren. Appreciate it.
You bet.